decisions. Welcome everyone. Today we are diving deep into the order book. By the end of this tutorial, you will understand how to use the order book to analyze market behavior, recognize trends, and make more informed trading decisions. Get ready because we have a lot to explore, and I promise by the time we are done, you will see the market from a whole new perspective. Have you ever wondered how traders can predict where prices might be headed next? One of the most powerful tools they use is called the order book. So what is an order book? Simply put, it is a real-time list of buy and sell orders for a particular stock or asset. It shows the price levels and the quantities that people are willing to trade at. This gives us insight into the forces of supply and demand. When we know what price levels have a lot of interest, we can better predict where the price might go. This is the key idea behind the order book. Understanding chart patterns can also help in this context. Chart patterns such as double tops, double bottoms, head and shoulders, triangles, wedges, pennants, and flags are visual representations of past price action that can give clues about future price movements. Double tops and double bottoms are reversal patterns that often indicate a shift in trend direction. A double bottom forms when the price hits a low level twice, showing strong support and signaling a potential upward reversal. Conversely, a double top forms when the price reaches a high level twice, indicating strong resistance and a potential downward reversal. The head and shoulders pattern is another reversal pattern, often seen at the end of an uptrend. It consists of a peak, the head, between two lower peaks, the shoulders. When the price breaks below the neckline, it signals a potential reversal to a downtrend. The inverse head and shoulders is the opposite, suggesting a reversal to an uptrend after a downtrend. Triangles are continuation patterns that indicate a period of consolidation before the price breaks out in the direction of the prior trend. There are three main types: ascending, descending, and symmetrical. An ascending triangle with higher lows and a flat top often signals a bullish breakout. A descending triangle with lower highs and a flat bottom often indicates a bearish breakout. A symmetrical triangle formed by converging trend lines can break out in either direction depending on the preceding trend. Wedges are similar to triangles but are typically longer in duration and signal a reversal rather than continuation. A rising wedge, which forms as the price makes higher highs and higher lows, often signals a bearish reversal. A falling wedge, which forms with lower highs and lower lows, is usually a bullish reversal signal. Pennants and flags are short-term continuation patterns that occur after a strong price movement called the flagpole. Flags are rectangular in shape and slope against the prevailing trend, while pennants are small symmetrical triangles. These patterns suggest that the price will continue moving in the same direction once the consolidation phase is over. These patterns often align with key price levels and order imbalances found in the order book. For example, a double bottom pattern forming at a major support level seen in the order book can be a strong indication that the price is about to rebound. This type of pattern shows that buyers are stepping in at a key level, and the failure to break below that level twice suggests strong support. Similarly, a head and shoulders pattern forming at a resistance level may signal a potential price reversal. This pattern indicates that the market is struggling to push higher, with the formation of the head representing an exhaustion of buying interest. Once the neckline is broken, it often leads to a bearish reversal. Triangles are another significant pattern to recognize in the order book. Ascending triangles indicate that buyers are gradually pushing the price higher, creating higher lows, while the resistance level remains consistent. This often signals a potential breakout, as buy orders accumulate at higher levels. Descending triangles, on the other hand, indicate that sellers are gaining control as they push the price to lower highs, and when support breaks, it usually leads to a bearish breakout. Symmetrical triangles show consolidation and can break in either direction, depending on where the order book imbalance tilts. A wedge forming at a significant price level might also indicate a reversal if confirmed by decreasing volume. Rising wedges are particularly noteworthy as they occur when the price is making higher highs but the volume is decreasing, suggesting that upward momentum is weakening and a reversal could be near. Falling wedges show the opposite, with price making lower lows but weakening selling pressure, often signaling a bullish reversal. Flags and pennants are also important to watch for in the context of the order book. These patterns generally form after a strong directional move, representing a period of consolidation before the trend continues. When you see large orders aligning with a flag or pennant, it indicates that traders are accumulating positions before the next move, providing a potential opportunity to enter in the direction of the trend. By recognizing these patterns in combination with the order book data, traders can make more informed decisions. This means not only identifying potential breakouts or reversals, but also understanding the context of buyer and seller interest at different price levels. Combining these insights allows traders to anticipate market moves more accurately and to position themselves effectively for both short-term and long-term opportunities. Always remember that no single pattern or tool guarantees success, but understanding how different pieces of information work together can increase the likelihood of making profitable trades. Now let us break it down a bit more. The order book is made up of two sides. On one side, you have buy orders. These are called bids. The bids represent how much the buyers are willing to pay and how much they want to buy. On the other side, you have sell orders. These are also called asks. The asks show how much sellers are asking for and how much they are willing to sell. The highest bid and the lowest ask are the most important prices in the order book. Together, they represent the current market quote. When we talk about the difference between the highest bid and the lowest ask, we call this the bid-ask spread. If the spread is narrow, that means there is a lot of trading activity, and the market is highly liquid. If the spread is wide, it could mean that there is less liquidity, or the market might be more volatile. The term market depth refers to the number of buy and sell orders at different price levels. The deeper the market, the more stable the price tends to be. The term order flow is about the continuous movement of buy and sell orders. If you can analyze the flow of these orders, you can start to see where pressure is building, either on the buy side or the sell side. So how can we use the order book for market analysis? Well, it is all about understanding the patterns in the orders. Imagine you see a large number of buy orders at a specific price level. This can act as a support level. It means buyers are ready to step in and prevent the price from falling any further. This type of support is often reinforced by patterns like double bottoms, where the price bounces off a key level multiple times, indicating strong buyer interest. The double bottom pattern reflects an inability of the price to fall below a certain level on two separate occasions, which signals strong demand. This type of pattern can often lead to a bullish reversal when confirmed by increasing buying volume. Similarly, large sell orders can act as resistance. It tells you that sellers are willing to step in and prevent the price from rising beyond a certain level. Resistance can also be seen in patterns such as double tops or head and shoulders, which signal potential reversals at key price levels. A double top pattern occurs when the price reaches a high point twice and fails to break through, indicating that sellers are dominant and a reversal may be imminent. The head and shoulders pattern is another classic reversal signal. It features three peaks, a higher peak between two lower ones, with the neckline serving as support. When the price breaks through the neckline, it usually confirms a bearish reversal. Another significant chart pattern to watch is the triangle formation. If you see buy and sell orders starting to converge, forming an ascending or descending triangle, it can signal an impending breakout. Ascending triangles usually indicate a potential bullish breakout when the price finally breaks through the resistance level, showing that buyers are gaining strength. On the other hand, descending triangles often indicate a bearish breakout as sellers dominate and the price breaks below the support level. Symmetrical triangles, formed by converging trend lines, represent a phase of consolidation and can break out in either direction, often depending on market sentiment and momentum. Wedge patterns also play a key role in analyzing market dynamics through the order book. A rising wedge, for example, can form when there are higher highs, but the volume of buy orders is gradually decreasing. This often signals a potential bearish reversal, as the upward momentum weakens and sellers start to take control. In contrast, a falling wedge, characterized by lower lows but weakening sell pressure, can signal a potential bullish reversal. This pattern is particularly strong when accompanied by increased buying volume, indicating renewed interest from buyers. Flags and pennants are also important to watch for in the context of the order book. These patterns generally form after a strong directional move, representing a period of consolidation before the trend continues. Flags are typically rectangular in shape and slope against the prevailing trend, while pennants are small symmetrical triangles. When you see large orders aligning with a flag or pennant, it indicates that traders are accumulating positions before the next move, providing a potential opportunity to enter in the direction of the trend. This kind of pattern is most effective when it occurs with supporting volume, as high volume during a breakout confirms the strength of the trend continuation. Recognizing these chart patterns in tandem with order book analysis provides a deeper understanding of market sentiment and potential price movements. For instance, if you notice a flag forming alongside an increase in buy orders at key price levels, it may indicate that buyers are preparing for the next leg up in a bullish trend. By analyzing both chart patterns and the order book, traders can gain valuable insights into the likely future direction of the price and make more informed decisions. The key here is to understand that the order book is dynamic. It is always changing as traders place, modify, or cancel their orders. By watching how the orders appear, change, or disappear, you can gauge how strong the support or resistance might be. Also, patterns like flags and pennants can develop when price consolidates after a significant move, and these are often good indicators of continuation in the direction of the prior trend. Recognizing these chart patterns in tandem with order book analysis provides a deeper understanding of market sentiment and potential price movements. Another significant chart pattern to watch is the triangle formation. If you see buy and sell orders starting to converge, forming an ascending or descending triangle, it can signal an impending breakout. Ascending triangles usually indicate a potential bullish breakout when the price finally breaks through the resistance level. On the other hand, descending triangles often indicate a bearish breakout as sellers dominate and the price breaks below the support level. Wedge patterns also play a key role in analyzing market dynamics through the order book. A rising wedge, for example, can form when there are higher highs, but the volume of buy orders is gradually decreasing. This often signals a potential bearish reversal. In contrast, a falling wedge, characterized by lower lows but weakening sell pressure, can signal a potential bullish reversal. The key here is to understand that the order book is dynamic. It is always changing as traders place, modify, or cancel their orders. By watching how the orders appear, change, or disappear, you can gauge how strong the support or resistance might be. Also, patterns like flags and pennants can develop when price consolidates after a significant move, and these are often good indicators of continuation in the direction of the prior trend. Recognizing these chart patterns in tandem with order book analysis provides a deeper understanding of market sentiment and potential price movements. Let us talk about what happens when there are more orders on one side than the other. We call this an imbalance. When there are significantly more buy orders than sell orders, it suggests strong demand pressure. This could mean that the price is likely to go up. If there are more sell orders, it signals strong supply pressure and could mean that prices will fall. Traders use these imbalances to anticipate short-term price movements. Another thing to watch is how the order book reflects market sentiment. If there are more buyers than sellers and the buy orders are being filled quickly, it often means that people are feeling optimistic. We call this a bullish sentiment. When the sentiment is bullish, prices are likely to rise. On the flip side, if there are more sellers than buyers and the sell orders are being filled faster, it usually means people are feeling negative. This is called a bearish sentiment, and it means prices could fall. You can watch how quickly orders are being placed or filled to spot shifts in sentiment. If you see a sudden increase in sell orders, it might be a sign of a reversal coming up. One of the best uses of the order book is for timing entries and exits. Say you notice large buy orders stacking up just below the current price. That could be a good sign to buy. Those orders could push the price higher. On the other hand, if you see sell orders piling up above the current price, it might mean a ceiling is forming. This could be the right time to sell before the price drops. Watching the flow of these orders will help you time your moves, especially in fast-moving markets. There are some patterns and signals you can look for in the order book that are really helpful. One pattern is called spoofing. Spoofing is when traders place large buy or sell orders just to cancel them before they are filled. It is a way to trick other traders into making a move. These fake orders might make you think there is more buying or selling interest than there really is, creating a false sense of market pressure. It is important to be cautious of these deceptive tactics, as they can lead to wrong decisions if you react too quickly. Another signal to watch for is called absorption. Absorption happens when large buy or sell orders do not move the price much. It tells you that someone is ready to take on all those orders without moving the price significantly, which can indicate strong support or resistance at that level. This type of activity suggests that there are large players, often institutional investors, who are willing to buy or sell at that particular price point, creating a stable zone in the market. Then there are iceberg orders. These are large orders that are broken into smaller parts to hide their true size. Iceberg orders can make it look like there is less demand or supply than there actually is. Traders use iceberg orders to execute large trades without causing a big impact on the market. Spotting iceberg orders can be challenging, but it often involves noticing repeated smaller orders at similar price levels, which can indicate that there is a much larger order behind them. Understanding these hidden orders can give you an edge by revealing the true market depth and helping you anticipate major price movements. Another pattern to consider is wash trading. Wash trading involves a trader buying and selling the same asset simultaneously to create artificial volume. This practice is often used to create the illusion of activity and interest in a particular asset. Recognizing wash trading can help you avoid being misled by what looks like high volume, but is actually deceptive market manipulation. By understanding these patterns, such as spoofing, absorption, iceberg orders, and wash trading, you can gain a more accurate picture of market dynamics. This knowledge will help you identify genuine buying and selling interest, avoid falling for market traps, and make more informed trading decisions. Now, the order book works best when you combine it with other analysis tools. For example, volume and price analysis can confirm the strength of buying or selling pressure. If you see large orders being filled and high volume, that is a strong signal of market direction. You can also add technical indicators like moving averages, the relative strength index, or the moving average convergence divergence to confirm trends or spot potential reversals. Additionally, understanding chart patterns such as head and shoulders, double tops, double bottoms, flags, pennants, triangles, and wedges can be extremely helpful. For example, if you see a head and shoulders pattern forming in conjunction with a declining volume, it can signal a potential reversal. Similarly, a double top pattern can indicate strong resistance and potential bearish movement if confirmed by weak buying pressure in the order book. Flags and pennants, which often appear after a strong price movement, suggest a continuation of the trend. Watching how these patterns align with large orders in the order book can provide a more comprehensive view of market dynamics. It is also very important to keep an eye on news and other external factors like earnings reports or economic data. These things can have a big impact on the order book, often shifting market sentiment and leading to new patterns or abrupt changes in support and resistance levels. Combining order book analysis with chart patterns, technical indicators, and fundamental factors can help create a holistic trading strategy that adapts to market conditions. Let me give you a few practical tips for using the order book in your analysis. Always keep an eye on large orders around key price levels. These are often the best indicators of where the market is going next. Be careful of market manipulation like fake orders. Look for consistent patterns rather than just reacting to one big order. And always remember that the order book is just one tool. You should use it as part of a broader strategy. Combine it with other types of analysis to get a fuller picture of what the market is doing. Now, let us talk about some common mistakes to avoid. One big mistake is overreacting to every small change in the order book. It is easy to get caught up in the noise, especially when the order book fluctuates constantly. Instead, focus on larger trends and chart patterns that reflect the overall sentiment of the market. For example, look for consistent formations like double tops, double bottoms, head and shoulders, or triangles, which can give you a better understanding of the bigger picture and avoid making knee-jerk reactions. Another mistake is forgetting the bigger picture entirely. The order book shows you what is happening right now, but it is only one part of the story. Always consider larger market trends, news events, and outside factors that might affect price movement before making a decision. Combining the insights from the order book with technical indicators and macroeconomic data will give you a broader and more reliable foundation for your trades. And finally, do not place orders without a clear plan. Know your entry, exit, and stop loss levels ahead of time so you are not making decisions based on emotions. A well-defined trading plan is essential for managing risk and maintaining discipline. It is important to stick to your strategy even when the market gets unpredictable. Reacting to every small move will often lead to mistakes, whereas a structured approach will help you achieve consistent results over the long term. If you are new to reading the order book, it is a good idea to start by practicing with a demo account. This way you can get comfortable spotting trends and key levels without risking real money. Practice with different markets. Try looking at the order book for different stocks or assets so you can see how the order flow changes between high-volume stocks and smaller, less liquid ones. Keep a log of your trades and compare them to your analysis of the order book. Over time, you will be able to refine your strategy and get better at reading the market. So to wrap things up, the order book is an essential tool for market analysis. It shows real-time buy and sell orders and helps you spot key levels of support and resistance. Start by tracking large orders and identifying those key levels. Then combine what you learn from the order book with other technical and fundamental analysis tools. Mastering the order book is one of the most valuable skills you can have as a trader. Keep practicing, combine it with other tools, and soon you will find it is an essential part of your trading strategy. Now I would love to hear your thoughts. Do you have questions about anything we covered today? Maybe there is a specific part of the order book you want to learn more about. Let us keep the conversation going, and I am here to help you on your trading journey.